Hello everyone and welcome to another video on accounting standards. In this video, I'm specifically going to talk about Hong Kong Accounting Standard 10, which is in short form, it's also known as HKAS 10. Again, it's very similar to the International Accounting Standards, IAS 10. So if you are preparing for your ACC exams, it is again a relevant material, so you can continue watching this video. But if you are more specifically preparing for the HKICPA exam, this standard is very much relevant, and from time to time there are questions in the financial reporting exam, which is module 11, and you would often see questions from this standard. Not They may not ask you, the examiners may not, the exam preparer may not ask you the question outright very specifically, but it may be asked within the case study, meaning that you might have to look out for this information. And under the panic mode, it's very often it's very easy to just ignore this information. So try to watch this video, and I'm pretty sure it's going to be helpful for you. Within this video, this I will put up the link in the description box where I got this Hong Kong Standard 10. It's publicly available, so there is nothing, you don't need to pay for it or anything like that. It's easily available and accessible. You can also study the same material from your learning packs or any other information. But let's dive into the video, and let's talk about what this video will be about. So within standards, you would see this is relatively a small standard. It's only 15 pages actually. So within standards, you would actually see these few things here: the objective of the standard, the scope, which basically defines what is covered, what is the coverage. So this is basically talking about what is the coverage of the standard. Then you would have simple definitions, recognition and measurement, which basically is accounting treatment about the standard, which the standard is actually about events after reporting period. This is also known as subsequent events. So events that happen after the financial reporting period. All right, so we will look at what is financial reporting period and what do we mean by events after reporting period. But this part here, recognition and measurement, this basically refers to the accounting treatment. And then you have two main important types of events. They're called adjusting events, and then the other one is called non-adjusting events. Few more other important items very specifically would be about dividends, going concern, and the disclosure requirements. So every standard has their own disclosure requirements. Same goes for subsequent events. HKS 10, they have their own disclosure requirements. So let's first study what is the objective of the standard, which was the first line in the content list. So the objective of this standard is actually to tell the accountant or the management, to tell the accountant or the management on how you should adjust your financial statements for events after reporting period. So there are two types, as we saw. There's adjusting event, and then there's non-adjusting event, right? So there are these two types of events that might happen after your financial statements period, and how as an accountant you will adjust these events. How would you take into account for these adjustments? So this is basically the objective of this standard, plus the disclosure requirements that entities should give about the date when the financial statements were authorized for issue, right? So basically in other words, how to adjust for events after reporting period, and the disclosure requirements. So these are like two objectives, right? These would be the two objectives. Let's look at the scope part. What is the scope of this standard? The standard shall be applied in the accounting for and disclosure again, right? So this is the adjustment part, and then this is the disclosure of events after the reporting period. So this is very important. You see that's why it's all written in bold. So by now we understand that this standard is only considered about what or how would you account for events which occur after the reporting period. All right, so let's look at some definitions, which is basically the core of this standard. The following terms are used in this standard with meanings specified. So there's events after reporting period, which basically is, so if I put into timeline, so let's say you're reporting, if the company has a reporting period of Jan to December, right? Anything after December. So let's say you are standing in March next year, anything that happens between this is events after reporting period. These are the events after reporting period. Now, these events could be favorable or unfavorable. An example of favorable event could be, you know, sell off a fixed asset at a price, or collection of an receivable, So because this is cash inflow. Now, cash inflow, of course, is going to be favorable. There are unfavorable events. So, for example, litigations. So there was a lawsuit against the company, and the company ended up paying. The company has a liability, and that was a cash outflow. These are cash outflows. At times, depending upon if company has to pay. So these would be unfavorable events, right? So you would have favorable and unfavorable events that would occur between the end of the reporting period and date when the financial statements are authorized for the issue, right? So this is very important. You have to understand that it's between. So let's say if I come back to this example, your reporting period was Jan to December, and then your authorization date, authorization of financial statements happened in March, right? And so things that happen between December and March are basically called as events after reporting period. Now these events could be favorable or unfavorable. So this paragraph that's all it's talking about. Then you have two types of events. You have adjusting events, and then you have non-adjusting events. So these again are very key concepts of this standard. Very key concept of this standard. Now, adjusting events are basically events for which the conditions actually exist at the end of reporting period. So the conditions actually exist. There's a hint, or there's something which is there at the end of the reporting period. And for non-adjusting events, the conditions are actually absent. So those conditions arose after the reporting period. So in other words, you can say that the conditions for non-adjusting events, the conditions were either absent, or they arose after the reporting period. Right. So you can use the terms used in standard, because that's what examiners in QP prefer. So rather than writing in your own words, you better stick to the words used in the standard. Right. So point 3 is very much important in this standard. It tells you what the standard is basically talking about. We look at point 4. The process involved in authorizing the financial statements for issue will vary depending upon the management structure. Now, this is a very general point, not really important, but you can read through these points. The important points here are understanding the period here, the financial period, the period for subsequent events, adjusting and non-adjusting events. So these are the types that you really need to understand and apply this to your case study based exam. Let's move on. So for example, here this is a very good example on this is a very good example on date of financial statements authorization. So if you just go through this, if you just take a quick look on this example here, so you see there are tons of dates. So I'm just highlighting the dates here. So if you see there are so many dates, if I count this 1, 2, 3, 4, 5, 6, 7, there are 7 dates given to us in this example. Now, what do you do with these 7 dates, right? There are so many dates. The question is basically asking you here when the financial statements were authorized, right? Or the date of authorization. The date of authorization. So if we read through this example, it tells you the company has an year end of 31st December. So year end is 31st December 2001 on 28th February, right? So financial statements, they completed. So completion happened on 28th Feb 2002. Then on 18th March 2000, the board of directors reviews the financial statements and authorizes them for the issue. So the date of authorization in this case is basically 18th March 2002. The rest of the dates, you should read them, but because I want to keep this video short, I'm going to ignore them. So basically, those dates are anyways irrelevant because the question has been answered. The question was about the date of authorization of financial statements, and you've already found that, which was 18th March 2002, right? So that this question or this example was very good. You have another example, and I would say actually you have this another example here. You should study this on your own. Otherwise, I mean, I can do everything, but again, with limited time, I really cannot do everything. So and it's good for you to do the practice by yourself. Then let's look at point 7. The point 7 basically talks about events after the reporting period include all events up to the date when the financial statements are authorized for issue. Again, so basically, you have to limit the time because you don't have a lot of time to take into account for subsequent events. So basically, this defines subsequent events. Basically, subsequent events are basically events between the date of financial year end and the date of authorization. So that's basically the definition of subsequent event, and we have already seen this. At the start of this video. Basically, it's already given to us. Let's look at the recognition and measurement. This basically is accounting treatment. Accounting treatment of adjusting events and non-adjusting events. Right. So you need to understand how will you adjust, how as an accountant or a company will make these adjustments in the financial statements for adjusting and non-adjusting events. So let's look at adjusting events first. So adjusting events so they have crossed this out, and now it's basically reporting period, because reporting period, reporting period is basically 12 months, or reporting period could be different as well. But generally speaking, it's going to be 12 months. So let's look at point number 8. An entity shall adjust. So this is important. An entity shall adjust the amount recognized in the financial statements to reflect adjusting events after the reporting period. So accountant has to adjust, right? So you have to adjust your financial statements. you have to make changes. You have to make changes to your financial statements. So let's look at, within the standards, you will actually see the examples are also given to you. So that's why studying from standards from time to time is it's good. It tells you it's very clear at times, like what kind of examples would fall into adjusting events. The following examples of adjusting events after reporting period that require an entity to adjust the financial statements. Right, so so basically that was the point 9, and let's look at examples here, which are given to us below. So there are a few examples that they have given us, A, B, C, D. So in example 8, basically it's talking about litigation. So the settlement after reporting period of a court case that confirms that the entity had present obligation at the end of reporting period. So right, so this is important. This is important. This tells you the conditions existed at the end of reporting period, and therefore this is an adjusting event, and the company will have to adjust the provision amounts. So that's basically that's the paragraph that's talking about. You can pause this video and you can basically read this to understand it better, and I would encourage you to do so. But if you want to continue watching, please feel free to do so. Point B is basically the receipt of information after the reporting period, indicating that an asset was impaired at the end of reporting period. Now, again, impairment, the conditions were existing, and then you would have to record for impairment loss. That impairment loss could be on inventories or a bankruptcy of customers. So these are 2 examples for which you will actually adjust the amounts. So let's look at point C, the remaining examples C, D, and E, which are very small. The determination after reporting period of cost of assets purchased or proceeds from the before the end of reporting period, right? So this would be like, as when I was starting, right, in the start of the video, I talked about favorable events. So this is like kind of a favorable event here, but again, favorable adjusting event. This is an adjusting event. Because the conditions existed before the end of reporting period. Then you have point D, the determination after the reporting period of the amount of profit sharing or bonus payments, right? So so basically you have this thing that your company pays bonuses, there are profit sharing schemes, and then there was a present or legal obligation at the end of the reporting period, and these payments were made after the reporting period, but still they are adjusting events because the conditions, the present and legal obligation existed at the end of reporting period. So these phrases here are quite important. These phrases here are quite important, I would say. And then discovery of fraud or errors that show the financial statements are incorrect. Now, for this, you may argue that it's hard to determine the condition, whether the conditions exist at the end of year or not. But you can put every things have exceptions. So this is basically an exception. This is also a material. This will also call material misstatement. So therefore, amounts need to be adjusted in this case. I mean, you cannot let go of fraud and errors that easily. Fraud and errors, they will impact your financial statements very materially, and being an ethical accountant, these things are very important, and you will have to pay attention to these things. Let's look at non-adjusting events. So for non-adjusting events, basically say that the entity shall not adjust. So right. So for adjusting events, you adjust, and for non-adjusting events, you don't adjust. Right. I mean, the word by itself tells you what you actually need to do. So for adjusting events, you have to adjust your financial statements, but for non-adjusting events, you don't really need to change anything. You don't really need to change any amounts. So no changes in amounts recognized in its financial statements to reflect non-adjusting events after the reporting period. They have given us an example of a non-adjusting event. So basically, an example of non-adjusting event after the reporting period is a decline in the fair value of investments between the end of reporting period and the date of financial statements are authorized for issue, right? So this is again very important. If you read this statement, right? So the event has to happen between the reporting period, between the, I would say, end of reporting period and the date of authorization for financial statement. If the event doesn't happen between this date, then it's not a subsequent event. If the event doesn't happen between this date, then it's not really a subsequent event. So it won't qualify for this example here. So it has to be, the event has to be between the end of reporting period for financial statements and the authorization date. Now, why this is a non-adjusting event? Because, you know, conditions of decrease in fair value didn't exist at the end of reporting period. This is like more like talking about stock market investments here. Let's say, I mean, as an example, if this is a stock market investment, it changes every day. We don't really know. It's hard to predict. So that's why, you know, these are non-adjusting events. The decline in fair value does not normally relate to the condition of investments at the end of reporting period, as I said earlier here. Right. Therefore, the entity does not adjust any amounts. So you're not going to adjust any amount here in the financial statements for investments. So you don't really need to do anything except disclosures. So similarly, the entity does not update the amounts disclosed for the investments, although it may need to give additional disclosures under paragraph 21, right? So disclosures may be required. So you have to be careful. With these tiny little things over there. Right. So, for example, now there are dividends. It's very common that companies, entities declare dividends to holders of equity investments after the reporting period, and the entity shall not recognize those dividends as liability at the end of reporting period. So basically, this is a non-adjusting event. But it could be an adjusting event if the announcement for dividend was made before the end of reporting period. So you have to be really careful reading these statements. Careful reading in financial reporting exam for your module 11 exam is very, very critical. And highlighting those accounting terms. This is not English. This is accounting language. It's written in English, but you have to pay attention to these terms, which are very accounting specific, and they have accounting meanings over there. So you have to really pay attention to that over there. You can read this paragraph 13 on your own. So it's probably informative. So you should read that on your own. Then you can read the part of going concern as well. If I have to put things very briefly, if your entity is if you decide that if you have to decide that you will liquidate the entity or cease trading, or it has no realistic alternative to do so, then you cannot prepare your financial statements on going concern basis, right? So you cannot really prepare your financial statements on going concern basis. You will have to report this, and these would be the disclosure requirements for that, right? So there would be material uncertainties related to the events or conditions that may cast significant doubt upon the entity's ability to continue as going concern. And the events and conditions that require disclosure may arise after the reporting period. So these disclosures would be really, really important. And then you have general disclosures here, which basically, here they just talk about, you have to mention the date of authorization for issue. An entity shall disclose the date when the financial statements were authorized for issue and who gave that authorization, right? So this would be one part of the disclosure. Then you have disclosures for non-adjusting events, and disclosures for adjusting events, right? Adjusting events, because it says here disclosures about conditions at the end of reporting period. So you would have to make these disclosures here, and you can always read them on your own. Reading them by yourself would make much more sense, and will make your understanding more better and concrete for the exam preparation. And that's what you really need to work on, where you really need to do that. So I hope this video was helpful to you. Thank you very much for watching till the end, if you have been watching till the end. And if you find this video helpful, please feel free to share with your friends. And don't forget to like, share, and subscribe to my channel for more videos like these. Thank you very much again.